So next standard in the series is IAS 21, the effects of changes in foreign exchange rates. So what do we need to do in this case? Now we deal with a lot of foreign transactions. Now how do we define which currency is a foreign currency and which transaction is considered a foreign transaction? Now depending on what is our functional currency. Functional currency is the currency in which we are doing our day-to-day operations. The currency in which we are dealing with. If I look at it from a layman's perspective, that if you are doing 100,000 transactions in dollars and if you are doing 20 transactions in INR and 30 transactions in Australian dollar or 15 transactions in Swiss franc, which is your functional currency? The currency in which you are dealing with all the time or most of the time is your functional currency. It doesn't matter where you are based. Even if you are based in India, you are based in Hong Kong, but if your majority of your transactions are in some particular currency, that is actually your functional currency. That is the requirement of every entity, that we need to first define what is the functional currency of that entity. Now, once we have defined the functional currency of an entity, depending on in which currency we are determining the sales price, what is the economic environment in which we are operating, and how we are funded, all these factors determine the functional currency. Once the functional currency is defined, any currency other than functional currency is considered foreign currency to us. Now, if we are based in India, but our functional currency is dollars, even INR will be considered foreign currency for us for converting the transactions. If we are dealing in any INR transactions, we have to convert those transactions into dollar to make our financial statements present in one functional currency. Now, when we are preparing our financial statements, we are preparing financial statements in our functional currency. And when we are converting these functional currencies, we need to convert all the foreign items into a functional currency for being able to prepare our financial statements. So that is a requirement. Now, if there is any item like dollar, 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 INR is foreign to us, then there is a transaction dollar, 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 Australian dollar, or in many transactions of dollars, there is a Swiss franc. These are foreign currencies. We need to convert them into functional currency to be able to present financial statements. So they are divided into two parts, whether monetary or non-monetary. Non-monetary is converted on the date of transaction, like we purchase an asset. When we purchase an asset, we purchase it in a foreign currency. We converted that foreign currency into functional currency, and we were able to record that item as part of our functional currencies. We bought it into Australian dollars. We have converted it into dollars, US dollars. Means we have recorded that transaction as part of our functional currency today. But if we are not paid for it, now this liability is a monetary item. We have not paid 200,000 Australian dollars for it. If you have not paid $200,000 at the end of the year, we need to repay this amount. There will be some settlement date in future, but as per the requirement of IAS 1, we need to show our financial position as on reporting date. So financial position on the reporting date, if there is a foreign currency item, that is 200,000 Australian dollar is a foreign currency item, we need to know what would be our liability as on date. So we'll take the exchange rate applicable on 31st March or on the reporting date. We'll be taking the rate and we'll convert it into functional currency and show our position on that date. When we settle it, the rate changes. When we settle it, the rate changes means there is a difference between the amount which we were liable to pay on the reporting date. But when we actually settle it, we may settle at a gain or we may settle at a loss. So monetary items need to be converted on the date of transaction. They need to be converted on the date of balance sheet. They'll also be converted on the date of settlement. If there is a non-monetary item, they'll be converted on the date of transaction. But there will not be any further conversion unless we apply revaluation model or unless we try to determine the valuation of inventories net realizable value, and this value is being derived from the foreign currency. If we are revaluing, we are getting the value in a foreign value. If we are trying to look at the net realizable value, the net realizable NRV we are getting in the form of foreign value. If we are doing so, then we may have to determine their values even in future, but otherwise non-monetary items are not converted. They are converted only on the date of transaction. Any exchange differences will be taken to profit and loss account in both the cases. But what if we have prepared our financial statements into US dollars and if the parent is based in India and they want us to convert all the financial statements into INR because they understand INR better? Now this is converting your functional currency into presentation currency. And now when we convert our functional currency into presentation currency, the management is not responsible for it and the entire difference is shown as part of OCI. We're not taking the difference to P&L. Now the question rises, how do we convert it? For all the P&L items, we convert them on the average rate. So what is the average rate applicable during the year, we'll apply that average rate on the P&L items, and we'll be converting all the functional currency items into presentation currency. The balance sheet items we can convert on the closing rate, and all the differences are equity items also are translated on the average rate. All the differences, exchange differences, are taken to OCI. This is how we deal with the exchange differences under IAS 21, the effects of changes in foreign exchange rates. Now, if you are converting any revaluation surplus, and revaluation surplus is shown as part of OCI, any exchange difference relating to that revaluation surplus will also be forming part of OCI. So be careful about these items. As I said, non-monetary items are converted on the date of transaction. But if there is any revaluation exercise, this may result in conversion at a future date as well. And if that revaluation surplus amount we are taking as part of OCI, take the exchange difference also as part of OCI in future. So this is all about IAS 21, the effects of changes in foreign exchange rates. So the next standard is IAS 23, borrowing cost. IAS 23 borrowing cost is the standard dealing with capitalization of interest. Now earlier there was no guidance available on it, so any interest which was being charged was being shown as part of P&L. But accountants were of the view that if you borrowed specifically for construction of an asset, can we capitalize the cost of the asset into the cost of making that asset? Now this was very subjective, and it required a lot of thought on it, whether which of the funds are being used directly on this construction of this asset and which of the funds are not being used. So if we borrow specifically, we know the interest cost, but if we do not borrow specifically, we are using general funds to construct this asset. It was decided that if it is a qualifying asset is something which takes substantial period of time to get ready for its intended use or sale. Now there was no definition of substantial. Substantial meant that it is taking a longer period of time, but there was no defined number of years that what is substantial. This is subject to judgment. If it takes a substantial period of time to get ready for its intended use or sale, it can be considered as a qualifying asset. Even it included inventories, like whiskey takes a maturity period of 18 years or 24 years. That whiskey can also be considered as a qualifying asset. And if you borrowed specifically for maturity of this whiskey, then we can include the interest cost as part of cost of making this asset, that cost of making those inventories. So capitalization will commence the moment we start spending that amount on construction of this asset. The capitalization will suspend for the time being if the active work is not happening, unless this delay is part of the process. Like if you are constructing a dam in Cherrapunji and it is normal that the work gets delayed by 1 month, that will be considered as part of the process. We'll cease capitalization when all the work necessary to complete the asset for it to be ready for use or sale is completed. We'll cease capitalization. Thereafter, any interest expense will be forming as part of P&L. So if we have used specific borrowings, we'll apply the specific rate. If you have used general borrowing, then we'll take the average capitalization rate and we'll apply that average capitalization rate to capitalize the cost of interest into the cost of making this asset. So this is all about IAS 23 borrowing cost. The next standard is related parties. The related party standard says that we need to identify all the related party transactions and we need to disclose the nature of all these transactions as part of notes to accounts. So who all are related is being guided by this standard. All the group companies having direct or indirect control are considered related parties. Close family members of the key management personnel are considered to be related parties. Any transactions with the key management personnel and close family members or the group companies is considered related party transaction, and we need to show the impact of it as part of the notes to accounts. So there are some instances which are not necessarily related parties, like two venturers may not be related. If they are part of a joint venture, they too may not be related to each other. A common director holding the position of a director in two entities, these two entities may not be considered relative, or suppliers or customers are not considered related. So this standard says that if there is any transaction which is biased, you need to disclose the impact of it as part of notes to accounts. So next standard is IAS 28, investment in associates and joint ventures. Earlier there used to be a standard known as IAS 31, interest in joint ventures, which is replaced now because it allowed proportionate consolidation and equity accounting. But since joint ventures now use equity accounting only, so this standard is merged with IAS 28. Now IAS 28 is known as accounting for associates and joint ventures, because accounting for associates and joint ventures is same. Equity accounting means whatever money you've invested, you're expecting some profit over it. And if you receive any dividends, your cost of investment reduces. If there is any impairment, your investment can reduce down to zero. It can reduce down to zero, but cannot go beyond it. So if you are presenting it in this manner, this is known as equity accounting. The cost of investment plus share of profit from that associate or joint venture, less any impairment, less any dividend. If you present it in this manner, this is known as equity accounting. So it is presented as a single line in the balance sheet. Investment in associate or JV, it is presented as a single line in the P&L. Share of profit from associate or JV. So this is known as equity accounting under IAS 28.
Thanks for watching. Do not forget to click the subscribe button and hit the bell icon. Do like, comment and share. See you next time. Subscribe and hit the bell icon.